339. Hold that number for a moment because it is not an estimate, it is not a projection, and it did not come from a critic or an activist. It came out of a company's own leather-bound ledger, and it means this. Of the first 1,000 life insurance policies ever sold by a firm founded on Wall Street in 1845, 339 were written on the lives of human beings who were legally classified as property, not on their freedom, not on their labor contracts, on their lives with a dollar value assigned to each one, a premium calculated against each one, and a payout promised to the person who owned them. If they died, that figure, 339 out of the first 1,000, was confirmed in a 2016 New York Times investigation that went through the company's own archives, page by page, with the company's cooperation. And here is the part that turns this from a history lesson into something else entirely. The firm that sold those policies did not go bankrupt, did not dissolve, and did not disappear into some footnote. It changed its name 4 years after it opened, and it operates under that name right now, today, as one of the largest life insurers in the United States. You have seen its name on television. You may have its name on a policy in a drawer in your own house. I am going to tell you exactly which company it is in a few minutes, and I am going to name others alongside it, because it was not alone, it was the pattern. Over the next 20 or so minutes, I am going to walk you through the ledgers themselves, the fine print inside the policies, the strange mathematical rule that proves the companies understood exactly what they were doing, and the law passed in the year 2000 that finally pried these files open. There is also one clause, buried in the boilerplate of these policies, involving a phrase called the hands of justice. That is the coldest sentence I have ever read in an American financial document. We will get to it. Here is exactly what this episode is going to put in front of you. First, the Wall Street company behind those 339 policies, the name it traded under then, the name it traded under name it trades under now, and the year its own trustees voted to stop. Second, the 2/3 rule, the reason almost no insurer would cover an enslaved person at their full market price, and what that discount quietly admits about what owners were expected to do. Third, the 3 escape clauses written into the fine print, including the hands of justice clause, which tied a private insurance contract directly to the public execution of human beings. Fourth, the California law signed in the year 2000, Senate Bill 2199, that forced every insurer doing business in the state to open its predecessor files, and the hundreds of names of enslaved people that disclosure put onto the public record. And fifth, the 3 physical locations, one in Harlem, one in Baltimore, one in Sacramento, where these documents sit today, open to researchers, open in some cases to anyone with an internet connection, which matters enormously if your own family history runs through the Upper South. A quick word on where this material comes from. This channel reads American history out of its surviving paperwork, deeds, ledgers, registers, filings, and this episode is built the same way. Everything you are about to hear. The story starts in the spring of 1845 in an office on Wall Street in Lower Manhattan, where a newly chartered firm called the Nautilus Insurance Company opened for business. The name sounds maritime, and originally the charter contemplated marine risks, but by the time Nautilus actually began writing policies, its business was life insurance, which in 1845 was still a young and slightly suspect product in America. Most Americans had never bought a policy on a human life. The industry needed customers, and it needed them fast, so Nautilus did what ambitious insurers did in that decade. It appointed agents far from New York, in Richmond, in Petersburg, in the towns of the Virginia countryside and further south, and it let those agents sell whatever the local market wanted to buy. What the local market wanted to buy, it turned out, was insurance on enslaved people. Specifically on enslaved men doing dangerous industrial work. Not field hands on cotton plantations for reasons we will get to, but miners, dock workers, boatmen, blacksmiths, railroad hands, men whose owners had either hired them out to industrial employers or put them to work in trades where death was a routine business risk. The Nautilus ledger from those first years survives, and its entries follow a grim template. A first name, because enslaved people were recorded without surnames. An age. An occupation. A county. A sum insured. A premium received. Line after line, page after page, human beings entered into an account book in exactly the format a company would use for cargo. Within roughly its first 2 years of operation, per the archival count later confirmed by both the company and the New York Times, Nautilus had written hundreds of these policies, those 339 among its first 1,000 contracts. Then, in 1848, something notable happened. The company's own trustees up in New York voted to stop writing new policies on enslaved lives. Whether that decision came from conscience, from actuarial nerves, or from the awkwardness of a northern institution profiting this directly from slavery, the minutes do not fully say. And the following year, 1849, the company shed the name Nautilus and adopted the name it still carries today, New York Life. The New York Life Insurance Company, today one of the largest mutual life insurers in the United States, the company whose archives produce that number, 339, and the company that in 2016 transferred its early records to a public research library so that historians and descendants could read them. New York Life did not hide from this history when it surfaced. It acknowledged it publicly. But here is the pivot, and it is the reason this episode exists. New York Life was not an aberration. It was not one bad ledger in an otherwise clean industry. It was the industry. To understand why, you have to understand the machine itself, how a policy on an enslaved person actually worked, because the mechanics tell you more than any speech from the period ever could. Start with the economic setup. By the 1840s and 50s, slavery in the Upper South was not only agricultural. Enslaved people were leased out, hired, in the language of the time, to coal mines in the Richmond coalfield, to railroads being blasted through the Appalachians, to tobacco factories, ironworks, and steamboats on the western rivers. An enslaved man in his 20s could carry a market price of $600, $800, over $1,000 at a time when that sum could buy a small farm. To the owner, that man was a capital asset generating rental income, and if he died in a mine collapse or a boiler explosion, the owner absorbed the entire capital loss. Insurance existed to move that risk for an annual premium, typically somewhere in the range of 1 to 3% of the insured value, higher for the most dangerous trades. A company in New York or Baltimore or Hartford would promise to pay the owner if the man died within the policy year. The policies were short-term, usually 1 year, renewable, and they priced occupation with actuarial care. A miner cost more to insure than a house servant because the companies kept mortality data and they knew exactly how these men died. Now here is the detail that unlocks everything, and it comes from the historian Sharon Ann Murphy, who spent years in the surviving ledgers of these firms and published the definitive study of the antebellum life insurance business. Almost no company would insure an enslaved person for their full market value. The standard practice, written into company rules, was to cover only about 2/3, sometimes 3/4, of what the person was worth on the auction block. Ask yourself why. If insurance is meant to make an owner whole, why deliberately leave 1/3 of the value uncovered? The companies answered that question themselves in their internal correspondence and their instructions to agents, and their answer is the single most damning fact in this entire story. They feared that an owner holding a policy for full value would have no financial reason to keep the insured person alive, no reason to provide medical care, no reason to pull a sick man out of a flooded mine shaft, no reason not to work him to death, collect a payout and buy a replacement. The 2/3 cap existed so that the owner always lost money when the insured person died, so that the owner's greed and nothing else stood between that human being and a fatal level of neglect. That cap is not a detail. It is the industry's own written admission that it understood precisely what its customers were capable of and that it built the product around that understanding. And it recasts every line of the Nautilus ledger, each entry, A first name, an age, a sum insured at 2/3 of value, is a small actuarial monument to the assumption that the man named on the line was in danger from the very person the policy would pay. The pattern repeats across the industry, so let me give you 3 cases, each one showing a different face of it. The first is the Baltimore Life Insurance Company. And Baltimore Life matters because for New York Life, slave policies were an early chapter. For Baltimore Life, they were the business. Founded in 1830, operating out of Maryland with agents spread through Virginia and the surrounding states, Baltimore Life drifted steadily toward the slave market until, by the 1850s, according to Murphy's study of the company's surviving records that sit today in the collections of the Maryland Center for History and Culture in Baltimore, a clear majority of the policies on its books covered enslaved lives. Its agents wrote coverage on enslaved men leased to the coal pits southwest of Richmond in the Midlothian district, some of the most lethal workplaces in antebellum America. Those pits flooded, collapsed, and exploded. Contemporary accounts record disasters in the Richmond coalfield that killed dozens of miners at a time, most of them enslaved. When that happened, the machinery of insurance worked exactly as designed. The mining company or the owner filed a claim. The company verified the death. A check went out to the owner, to the man's wife if he had one, to his children if he had them. The contract owed nothing because the contract had never been about them. The beneficiary of a policy on an enslaved life was, by definition, the person who held title to it. The second case is the Aetna Insurance Interests of Hartford, Connecticut, and this one matters because of how the record surfaced. Aetna's predecessor wrote policies on enslaved lives in the 1850s, a fact that sat in archival silence for nearly a century and a half until a law student named Dedria Farmer Palman began writing to American corporations in the late 1990s asking a simple question: what do your own archives contain from the slavery era? Aetna searched, found surviving sample policies, and in March of the year 2000 did something no major American insurer had done before. It publicly acknowledged the policies and expressed regret for them, on the record in the national press. Note the geography here because it is the quiet theme of this whole episode. Hartford, Connecticut, New York City, Baltimore. The premiums were collected in the north. The risk being priced was southern. The people being priced had no say in any of it. Slavery is remembered as a southern institution, but its financial plumbing ran straight through the northern cities that still dominate American finance today. The third case is not a company at all. It is a law, and it resolves the promise I made you at the top about the state that forced the files open. In the year 2000, California enacted Senate Bill 2199, creating what became known as the Slavery Era Insurance Registry. The mechanism was elegant. California could not legislate for Alabama or Virginia, but nearly every major American insurer sells policies in California, and the bill made continued access to that enormous market conditional on one thing: disclosure. Any insurer doing business in the state had to search its own records and the records of every predecessor company it had absorbed and report to the California Department of Insurance any policies ever written on enslaved people. In May of 2002, the department published its report, and the filings named names. New York Life appeared, consistent with the Nautilus ledger. Aetna appeared, and a company called United States Life appeared, a firm whose corporate line of descent ran forward into the portfolio of AIG, the insurance giant, which duly disclosed its predecessors' policies. But the report did something more important than embarrass corporations. The disclosed records contained the names of hundreds of enslaved people. The department's compilation listed roughly 600 of them, alongside the names of the slaveholders who had taken out the policies, and it put those names into a public state document, searchable, permanent. For some of those individuals, a premium receipt from the 1850s and a line in a Sacramento registry are the only places their names were ever written down. So let me now lay out, in order, the 5 things the surviving paper actually establishes, because each one closes a promise from the top of this episode. Finding 1. The company. The Nautilus Insurance Company of Wall Street, chartered in 1845, wrote 339 of its first 1,000 policies on enslaved lives, sold largely through its southern agents, until its trustees voted in 1848 to stop, and in 1849 it became New York Life, the same New York Life operating today, which confirmed these figures from its own archives and made. Which brings me to the one thing in this episode you can actually use, and it is something most people, including most genealogists, do not know exists. If your family history runs through Virginia, Maryland, Kentucky, or the industrial towns of the Upper South, the slavery-era insurance disclosures are a genealogical source and in some cases an irreplaceable one. Enslaved people were systematically excluded from the records that family historians normally rely on. Census schedules before 1870 list them as unnamed tally marks, and most left no birth certificates, no marriage licenses, no property records. But an insurance policy, of all things, recorded a first name, an approximate age, an occupation, a county, and the name of the slaveholder, and the slaveholder's name is often the key that unlocks a family line. Because freed people frequently appear near former owners in the 1870 census. Researchers have used the California registry names in exactly this way. Now the honest caveat, because this source has sharp limits. Slave insurance skewed heavily toward industrial and skilled male workers in the Upper South. The millions of men, women, and children who worked cotton and rice in the Deep South were rarely insured, so the absence of a name from these records proves nothing at all about a family's history. But if your people were miners, boatmen, ironworkers, blacksmiths in that region, there is a real chance a company in New York or Baltimore once put a price on one of them, and that document, written to protect an owner's investment, may today be the only surviving record of your ancestor's name and trade. That is the strange, bitter inheritance of this paper trail. The ledgers were instruments of the machine. A century and a half later, they are evidence against it. If you take one thing from this episode, take the 2/3 rule, because everything else follows from it. The companies that wrote these policies were not confused about what slavery was. They studied it, priced it, and built a discount into their product specifically because they understood that the men whose lives they were insuring were in danger from their own policyholders. 339 entries in one Wall Street ledger, a majority of the book at Baltimore Life. Roughly 600 names surfaced by one California statute. The firms consolidated, renamed, and endured, and some of the largest names in American insurance today carry this paper in their corporate ancestry, which we know not from rumor, but because a state law made them look, and because some of them, to their credit, opened the archives themselves. Money does not remember, paper does. And this channel exists to read the paper. If this episode showed you a piece of American finance you had never seen before, a like genuinely helps this kind of research reach more people, and if you want more of the hidden history of American money and power, subscribe so you do not miss what we open up next. I will see you in the next one.